Picture this. It is a Friday afternoon in a cosmopolitan, heavily integrated modern city. You are an educated professional who has spent 3 decades operating responsibly within the economic system. You have paid your taxes, avoided speculative debt, and built a substantial balance in your domestic savings account. You believe you have constructed an impenetrable wall of financial security. You walk to your local bank branch to withdraw cash for the weekend, but the doors are locked. A hastily printed piece of paper is taped to the glass, informing the public that all withdrawals have been suspended indefinitely. The numbers on your digital banking application remain unchanged, but their purchasing power has vanished. The institutions you trusted with your stored economic energy have effectively defaulted. This is not a hypothetical scenario designed to generate anxiety. This exact sequence of events has played out with mathematical precision across multiple jurisdictions, from South America to the Middle East, destroying the life savings of millions of rational, responsible citizens. When a sovereign debt crisis reaches its terminal phase, the architecture of paper wealth inevitably fractures. The historical record demonstrates that the average lifespan of a fiat currency is merely 27 years before it succumbs to severe debasement or total failure. The current global reserve system, untethered from physical constraints since 1971, is rapidly approaching this statistical event horizon. When the rules of modern finance are abruptly rewritten, conventional investment strategies become mathematical traps. Domestic government bonds are functionally a claim against a failing state, and savings accounts become locked repositories of evaporating purchasing power. However, the global economy does not simply stop functioning during a sovereign collapse. It violently reorganizes itself around different mediums of exchange. By examining a century of economic data across distinct geopolitical crises, we can identify a highly specific set of assets that consistently survive institutional failure. More importantly, we can understand the precise mechanical reasons why these 5 assets thrive while paper wealth goes to zero. The first asset class that reliably survives a systemic monetary collapse is intensely counterintuitive to the average investor. It is productive corporate equity. The conventional assumption is that a collapsing economy annihilates the stock market. The forensic data proves this assumption is entirely incorrect. A share of stock is not merely a paper derivative. It represents fractional ownership in tangible infrastructure, industrial equipment, commercial inventory, and specialized human labor. When a national currency begins to lose its purchasing power, the nominal value of these hard corporate assets mathematically rises to match the rate of inflation, precisely because the physical factories and distribution networks have not ceased to exist. We can observe this exact phenomenon in contemporary crisis zones. During the terminal phase of the Venezuelan economic collapse, as the domestic currency was entirely destroyed by hyperinflation, the national stock exchange experienced explosive parabolic growth. Individual manufacturing and telecommunications equities surged by thousands of % in a matter of days. However, there is a critical distinction that separates the investors who preserve their wealth from those who lose everything. Not all corporate equities survive a sovereign debt spiral. If you own shares in a company that generates its revenue entirely within the borders of the collapsing economy, the real profitability of that company will be crushed. The business will be forced to exchange increasingly worthless domestic currency to purchase the imported materials required to maintain operations. The precise mechanism for survival requires holding productive equities that possess robust, diversified export capabilities. When a nation's currency collapses, a company that manufactures goods domestically but exports its products to stable foreign markets suddenly possesses a massive mechanical advantage. The company receives its revenue in hard, stable international currency, while its domestic labor and operational costs, denominated in the failing local currency, plummet in real terms. The real profitability of the enterprise actually improves during a severe currency devaluation. Academic research analyzing the Latin American debt crises and the Asian financial meltdown confirms that direct investors holding export-oriented manufacturing equities survived the systemic instability with their purchasing power completely intact. While productive equities preserve wealth at the macroeconomic level, they provide absolutely no utility during the acute, chaotic phase of a localized economic collapse. When digital payment systems freeze and supply chains disintegrate, the economy instantly reverts to localized barter. In this environment, the second asset class that dominates the market is high-utility consumables and practical survival goods. During a severe institutional failure, abstract financial wealth loses its immediate relevance. The capacity to address fundamental human requirements dictates all economic value. The historical precedent for this reversion is absolute. During the devastating siege of Sarajevo in the early 1990s, the transition from a modern, wage-based economy to pure physical barter occurred in a matter of months. In an urban environment lacking electricity, reliable water processing, and established food distribution, conventional stores of wealth failed completely. Individuals holding precious metals often found themselves trading valuable jewelry for minimal amounts of sustenance, simply because a gold necklace cannot be consumed for calories or burned for heat. The assets that commanded extreme premiums were those that solved immediate biological problems. Standardized, divisible, and non-perishable goods functionally replaced the national currency. Antibiotics, which cost very little in a stable economy, became life-saving instruments that could command the equivalent of months of wages. Basic hygiene supplies, such as bleach and soap, became incredibly valuable because they prevented the spread of deadly infections in a compromised environment. The most profound realization from the survivors of this crisis was the immense value of simple, distributed fire-starting tools. While some individuals relied on expensive, noisy fuel generators that attracted theft, those who stockpiled thousands of inexpensive disposable lighters possessed a highly divisible, silent, and easily transportable medium of exchange. These items provided the non-negotiable necessities of cooking, heating, and light. Consumables cannot form the foundation of a permanent generational wealth portfolio because they are eventually depleted. However, holding a strategic allocation of these highly liquid barter goods provides the exact tactical capital required to navigate the most dangerous, acute phases of a systemic transition. Once the immediate crisis stabilizes, long-term wealth preservation depends on assets that generate continuous, unprintable value. This brings us to the third asset class, productive agricultural land. Throughout modern financial history, raw acreage has served as the ultimate immobile store of economic energy. Unlike urban commercial real estate, which produces rental income denominated in a collapsing local currency and relies entirely on the solvency of tenants, agricultural land produces the single commodity that human civilization cannot negotiate away. It produces caloric energy. During the Great Depression, the wealth disparity between urban workers and rural landowners was stark and undeniable. While the industrial workforce faced severe unemployment and urban destitution, individuals who held productive agricultural land possessed an immense structural advantage. They possessed the physical infrastructure to generate their own food, maintain livestock, and isolate their families from the catastrophic failure of the financial markets. They produced direct utility regardless of what was happening to the banking sector. The statistical performance of farmland during institutional stress confirms its position as a superior defensive asset. During the severe global financial crisis of 2008, while broader equity markets collapsed by 46%, the valuation of agricultural land actually increased by 17%. Furthermore, its historical volatility is significantly lower than both the stock market and precious metals, while its returns during periods of extreme inflation consistently average double the inflation rate itself. However, this asset class carries specific vulnerabilities that require sophisticated management. Land is entirely illiquid, impossible to conceal, and highly vulnerable to predatory taxation by desperate governments. The historical record, notably the rapid expropriation of commercial farms in Zimbabwe, demonstrates that land must either be positioned in highly stable jurisdictions with absolute property rights or structured legally to resist arbitrary state confiscation. Because domestic assets like land and local businesses remain under the physical control of the failing state, the fourth survival asset is entirely jurisdictional. It is the acquisition and physical possession of foreign hard currencies. When a sovereign nation enters the terminal phase of a debt crisis, the local population instinctively recognizes that their domestic money is failing. Rational economic actors do not wait for official government decrees. They immediately abandon the dying currency and substitute it with the circulating money of a stable foreign power. We can observe the precise mechanics of this transition in the modern collapse of the Lebanese banking system. For 2 decades, the Lebanese pound maintained a rock-solid peg to the United States dollar, and educated professionals kept their life savings within the domestic banking infrastructure. When the sovereign debt crisis inevitably broke the peg, the domestic currency lost 98% of its purchasing power in a mere 4 years. A lifetime of accumulated financial energy was mathematically eradicated, yet individuals in the exact same geographic location who had the foresight to hold physical United States dollars outside the domestic banking system maintained 100% of their wealth. This dynamic is not unique to the Middle East. It is a universal mathematical reality. The economies of Zimbabwe, Ecuador, and El Salvador organically dollarized themselves as their populations outright rejected the failing local fiat. In modern Venezuela, the population utilizes foreign currency for major transactions despite the domestic fiat remaining the technical legal tender. A government can mandate the use of a collapsing currency, but it cannot force a population to value it. Holding physical, stable foreign fiat acts as a localized escape valve. It allows you to operate within a collapsing economy using a unit of account that is entirely disconnected from the fiscal mismanagement of your local politicians. However, even foreign fiat currencies are ultimately paper instruments subject to the monetary policies of their issuing central banks. To achieve absolute, uncompromised wealth preservation, we must examine the fifth and most critical asset. It is the only asset that transcends all political regimes, requires no institutional validation, and has survived every single economic collapse in recorded human history. That asset is physical precious metals, specifically fractional gold. The financial elite and retail investors drastically misunderstand the true function of gold during an economic crisis. The conventional assumption is that you stockpile gold coins to purchase groceries when the banking system fails. As we have already established, this is highly inefficient during an acute emergency. Gold is not a mechanism for daily barter. Gold is a Tier 1 reserve asset designed to carry purchasing power across the chasm of total state failure, allowing you to cross borders, evade capital controls, and rebuild your wealth after the political regime has been replaced. When the supply of a fiat currency explodes into the trillions to service unpayable national debt, the purchasing power of every unit collapses. Because the physical supply of gold cannot be expanded by a central bank or a political committee, its relative value mathematically surges by default. During the hyperinflation of the Weimar Republic, individuals who held paper marks lost absolutely everything. Those who had converted their wealth into physical gold maintained their purchasing power entirely, capable of buying the exact same basket of goods before, during, and after the total annihilation of the German currency. But the true utility of gold is revealed when the crisis forces you to move. When a nation collapses, borders close, and desperate governments institute severe capital controls. If your wealth is trapped in a digital banking matrix, you cannot transport it. When millions of Vietnamese citizens fled their country following the collapse of Saigon, the most sophisticated survivors utilized an extraordinarily specific protocol. They systematically converted their life savings into incredibly thin sheets of pure gold known as gold leaves, which could be tightly wrapped and disguised. These fractional, concealable units of wealth allowed them to transport massive amounts of purchasing power across hostile borders in packages no larger than a deck of playing cards. This reveals the most dangerous mistake modern investors make when acquiring precious metals. They purchase standard 1-ounce gold bars. In a true systemic crisis, a 1-ounce bar is a massive liability. It is highly conspicuous, incredibly difficult to fractionally divide without specialized equipment, and represents far too much concentrated value for a single transaction. If you are forced to bribe a border guard or secure emergency transport, offering a 1-ounce bar guarantees massive overpayment, invites complex negotiations regarding change, and immediately signals to hostile actors that you possess immense hidden wealth. The forensic data dictates a completely different strategy. The optimal architecture for holding precious metals is the accumulation of fractional units, specifically 1 gram, 5 gram, and 10 gram bars. A 1 gram bar represents a universally recognized, instantly verifiable unit of value that requires no complex calculation. It allows you to distribute your wealth discreetly, deploy specific amounts of capital at different stages of a jurisdictional escape, and prevents the catastrophic loss of your entire net worth if a single transaction goes wrong. When institutional authority completely evaporates, paper assets become worthless because the governments backing them have lost their legitimacy. A border guard representing a collapsing regime will not accept a bribe denominated in the dying currency of that regime, but that same guard will universally accept physical gold because gold's value is derived from its elemental scarcity, not from a political promise. Gold can be exchanged for immediate purchasing power in the wealthiest banking centers of the world and in the most impoverished informal markets on Earth. It is the universal language of survival when the state becomes your enemy. We are not observing isolated anomalies. We are watching the mechanical progression of a historical cycle. The United States currently carries a national debt of $38 trillion. The interest payments required simply to service this debt now exceed the budget of the entire military apparatus. The share of global foreign exchange reserves held in dollars is steadily declining, following the exact mathematical trajectory that destroyed the supremacy of the British pound over a century ago. Global central banks, the very institutions that manage the fiat system, are currently purchasing physical gold at the most aggressive pace recorded in decades, accumulating more precious metals than sovereign treasury bonds for the first time in modern history. They are executing a quiet, systematic flight into hard assets because they understand the mathematical reality of the balance sheet. You do not need to panic, but you must recognize the pattern. Genuine financial security is not achieved by hoarding paper currency in a system designed to structurally debase it. True diversification requires acknowledging that different assets perform entirely different functions during the varying stages of an economic collapse. You must hold export-driven productive equities to protect against localized inflation. You must stockpile tactical barter goods to navigate short-term institutional freezes. You must secure productive land to ensure caloric independence. You must maintain access to foreign hard currency to bypass domestic banking controls. And you must hold physical, fractional precious metals to guarantee your wealth survives across borders and beyond the lifespan of the current political regime. The economic autopsies have been written. The mechanics of sovereign default are entirely predictable. The institutions are already positioning themselves for the transition. The only remaining variable is whether you will apply these historical lessons and restructure your portfolio in time, or whether you will be left holding the paper obligations of a mathematically broken system. Position your assets accordingly.